If I gave you 10,000 Kenyan shillings right now, how would you invest it? Would you save it, trade it, or just spend it? Most high-income earners in Kenya underestimate what they can do with 10,000 shillings. They think they need millions to start investing. I'll show you how to turn your 10,000 shillings monthly contribution into a well-diversified portfolio that can actually grow for the next 10 years. This is exactly how you start building real wealth, one month at a time. Let's be honest, 10,000 shillings doesn't sound like much today. It's 2 dinners in Westlands, 3 Uber rides from CBD to Karen, or a quick impulse splurge online. But here's the thing, that same 10,000 shillings, invested consistently for 10 years, could fund your first property deposit, your kids' education, or early retirement. Consistency beats timing every single time. It's not about catching the perfect market moment, it's about showing up every month. Investing is like going to the gym. You won't see results after one session, but 10 years of small repetitions build real financial muscle. Here's the golden rule: before you pay the supermarket, your holiday, or landlord, pay your future self. That means automatically investing a part of your income the moment it hits your account. Automation removes emotion. It turns investing from a choice into a habit. Follow these steps to begin your investment journey on the right path. Before you even start investing, make sure your foundation is solid. Here's your 3-part checklist. Number 1. Have an emergency fund, at least 3 to 6 months of expenses. However, the typical 3 to 6 months of savings may fall short, especially for young high-income earners with steeper living costs. Aim for 9 to 12 months of expenses for greater security. Number 2. Pay off high-interest debt. For example, if you have a 50,000 shillings credit card balance, clear it first. That alone can save you significant interest before you even invest a shilling. Number 3. Get basic health and life insurance cover. Once you have set the foundation, define your investment horizon and goals. Ask yourself, what am I investing for? Is it to buy a home? Build passive income? Or achieve financial freedom? I encourage you to get a notebook and write down your goals. Think of your investment plan like Google Maps. You can't reach the destination without knowing where you're headed. If you can consistently set aside 10,000 Kenyan shillings a month, you're not just saving, you're building a habit that could change your financial destiny. I'm now going to show you exactly where to invest that 10,000 Kenyan shillings every month. I'll break it down between money market funds, local stocks, and even global ETFs. Let's build your investment plan and break it down into 4 simple buckets. You can tweak the percentages based on your goals and risk appetite. First, allocate 40%, or 4,000 Kenyan shillings, to a money market fund. This is your safety net. It keeps your money liquid and stable while still earning solid returns. MMFs are low risk, give you easy access to cash, and earn around 10 to 12% annually. Start here. It builds your confidence and gets your money working immediately. Next, 25%, that's 2,500 Kenyan shillings, goes into local stocks or REITs. This gives you a piece of Kenya's growth story. Think of it as owning a share of the economy. You're literally buying small pieces of strong Kenyan businesses like Safaricom or Cooperative Bank. Over time, these offer dividends and long-term growth. For example, if you had invested 10,000 Kenyan shillings in Safaricom in 2010, it would be worth over 150,000 Kenyan shillings today. Then another 25%, or 2,500 Kenyan shillings, goes to global ETFs or mutual funds, a smart move for diversification. This expands your portfolio beyond Kenya. Now for real diversification, consider investing globally. You can use platforms like Absa Global Investment Funds or Interactive Brokers. Here you gain exposure to companies like Apple, Microsoft, Google, and ETFs that track the S&P 500 or MSCI World Index. Most young professionals think global investing is for the rich or a status symbol. But what if I told you it's actually a form of insurance, not for your car, not for your health, but for your money itself? Global investing isn't about showing off that you own Tesla shares or that you've gone international. It's about protecting your hard-earned wealth from the silent erosion caused by currency depreciation and local market shocks. When your entire portfolio is in Kenyan shillings, you're exposed to one economy, one currency, and one government's policy decisions. But when you diversify globally, you're spreading your financial roots across stronger, more stable currencies like the USD, GBP, or Euro, and industries that aren't dependent on local conditions. For example, in 2020, if you had 10,000 Kenyan shillings in savings, you lost nearly 20% of your purchasing power within months due to currency fluctuations and inflation. But an investor who held part of that in US index funds or dollar-denominated assets retained their value and even gained when converted back to shillings. Global investing isn't about chasing trends, it's about hedging risk, preserving value, and building resilience. Because the goal isn't just to grow your money, it's to protect its real power across time and borders. And finally, 10%, or 1,000 Kenyan shillings, goes into personal development, books, courses, or coaching. This one surprises many young high-income earners, but it's the highest return investment you'll ever make. Use part of your 10,000 Kenyan shillings to grow your income potential. Take a financial course, upgrade your skills, or attend a wealth workshop. Because the best investment you'll ever make is in yourself. If you use this to fund a course that aligns with your skills, your salary can double within a year. And you'll invest more confidently. Now here's the trick: automate everything. Set up a standing order from your salary account so your investments happen before you even notice. Discipline isn't about willpower, it's about removing friction. Once it's automated, you're already winning. That's your simple balanced 10,000 Kenyan shillings monthly plan, part safety, part growth, and part self-improvement. Follow this consistently to build a wealth foundation that compounds over time. This is how you start small, stay consistent, and scale your investments like a pro without stress. So now you know exactly where to invest your 10,000 Kenyan shillings every month. But what will that look like in 10 years? I'll project your 10-year outcome, how much you will have, how to manage risk, and how to protect your gains. What if you could look 10 years into your financial future? Would you like what you see? Let's talk about what actually happens when you stay consistent, investing 10,000 Kenyan shillings every month for an entire decade. And when you see the numbers, you'll realize consistency isn't boring, it's powerful. Let's run the math. If you invest 10,000 shillings every month for 10 years, here's what happens. If you earn an average return of 6% per year, your 1 million shillings could grow to around 1.6 million shillings. Push that up to 8%, and you're now looking at about 1.9 million shillings. That's an extra 300k just by getting a slightly better return. At 10%, your money compounds to around 2.1 million shillings, and that's before adding any extra contributions. And if you manage a strong 12% return, you could hit roughly 2.3 million shillings. So even a small difference in your annual return, just 2 or 3%, can mean hundreds of thousands of shillings over time. That's the quiet power of compounding, the key reason smart investors focus on consistency and time in the market, not just chasing the highest rates. There are 3 things that can change your final returns. Number 1, inflation. Inflation in Kenya averages around 6 to 7%, so you want investments that beat that. Number 2, currency shifts. Diversifying into global ETFs can hedge against shilling depreciation. And lastly, market returns. Remember, volatility is normal. Markets rise and fall, but long-term investors win. At year 5, do a mid-course review. Ask yourself these 3 questions. Am I still consistent? Do my investments match my goals? Has my risk tolerance changed? At year 10, it's time for what I call the decade decision. You've built momentum, now decide how to grow or protect your wealth. You've worked hard to build this, now it's time to protect it. Ensure you have insurance cover, think health, life, and income protection. Factor in tax efficiency, use investment vehicles that reduce drag. Another important thing is diversification. Diversify across assets and currencies. And don't forget to keep liquidity, invest in MMFs and short-term bonds for stability. For example, if you are unable to work for 4 months, your MMF fund can keep your investment plan safe. Even the smartest investors make these mistakes, so here's what to watch out for. Emotional investing during market dips, chasing quick returns or crypto hype, ignoring fees and taxes, and stopping after a few months. Remember, consistency beats excitement. So don't stop just because the market or your mood changes. Don't let emotions trade your goals. So what happens after 10 years? Now you're entering the wealth acceleration phase. This is where your investments start working harder than you do. It's like shifting from driving uphill to cruising downhill. Your money starts gaining momentum. This is when you start planning for impact, legacy, family goals, or even entrepreneurship. Now that you know exactly how to invest 10,000 Kenyan shillings every month, start your 10-year plan today. And when you're ready to scale your monthly contributions, here's something to think about. What if instead of 10,000 Kenyan shillings, you invested 50,000 Kenyan shillings every month for 10 years? The difference is massive, and I break it down in this video. I'll lay out your investment roadmap, step by step.